Hello everyone, Corey here with the Cyclical Investors Club, and this week I'm focusing on the theme of highly cyclical stocks, and the buy idea for this week for highly cyclical stocks. I actually have two of them for you here in this video, but I'm probably going to focus on just one of them, but they're both should behave about the same price-wise. They're both oil refiners and fuel refiners. One is named Valero, and the other is HollyFrontier. And these are both highly cyclical stocks that I think still have a lot of potential upside left to them as fuel demand rises. And so in this video, I'm going to get into the details of that and kind of explain it to you. Right after this short disclaimer, we'll get into the analysis. Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. Okay, before we get into the Valero and HollyFrontier analysis in this video, I always like to take a look at what my buy ideas have produced from the past. Now we're into our fourth week here on the YouTube channel. So we had one buy idea each week out of the S&P 500 index, and so far they're doing okay on an absolute basis. They've returned about 1%, but Anthem, which has kind of taken a hit here, is down close to 7%. So the S&P 500 has actually outperformed so far. So on a relative basis, we're trailing the S&P 500 by just a little bit, and we'll track this over the long term, and we'll see as time goes on if this kind of works itself out, and hopefully we can come back and start outperforming the index. But so far, I mean, we're okay. The stocks we're picking are rising. 2 out of 3 of them are doing okay. And even though we're trailing the index, we're pretty early on. Okay, now let's get into the Valero and HollyFrontier analysis. Okay, we are in the 4th week of January 2021 right now, and my buy idea from the stocks in the S&P 500 this week is going to be Valero. I actually have 2 of them. They should move pretty similarly. Is Valero. The one thing I want to note here is there's a couple things. First is the second one is HollyFrontier. So this is Valero, and then I'll let you have a quick look at HollyFrontier, and you'll notice how similar they look. I'm not going to cover both of these stocks. I'm mostly going to focus on Valero, but basically everything that I say about that is pretty much true for HollyFrontier as well. I'm just going to note a couple of differences here. One is that the dividend yield for the HollyFrontier is a little lower, so it's like 4.8 instead of 6 something for Valero. So if you're more of an income-oriented investor, you might lean more toward Valero. Also, the credit rating of HollyFrontier is 1 notch lower than Valero. I think Valero is BBB and these guys are BBB minus. Other than that, they're both refiners. They usually move very closely together in terms of the stock price, so the returns are going to be pretty close, but you might get more of a price return from HollyFrontier, and you might get a little less of a price return with Valero, but that will be probably made up for with the dividend. Now, these dividends aren't guaranteed. If earnings don't recover the way they're expected to, they could be cut. But as time goes on, and now that we have a vaccine for coronavirus, I'm leaning more and more toward the idea that these companies might be able to continue paying these dividends, which would be a huge lift for investors that are buying right now. I am long both of these. I first bought them in March during the March sell-off, and they've been a little slow to recover, and I bought more after the vaccine was announced in November. So I'm loaded up pretty heavy on refiners. I would say that it's one of the only places I'm really overweight in my portfolio. because I still think there's a lot more upside potential for them, especially compared to other cyclical stocks, which suffered, I think, a lot more than these guys did. And I'll talk about some of those ideas in my sell and avoid, especially my avoid section this week too. It's not going to be in this video. You have to look for that video. It'll be on Carnival Cruise Lines. So with that said, I want you to get an idea of what I'm looking at here. So historically, we've seen these big earnings swings for Valero. They go up here, and that was one peak, and then they go up here, and that was another peak, and then they come up here. This one, this peak is kind of a super cycle, and this one I think is more realistic for what we might see in a recovery over the next 3 to 5 years. So I think we could see this type of earnings, this shaded dark green area here, again here in a couple more years in the future. My thinking behind this is we have a lot of stimulus money going into the economy. Once we start getting these vaccines out, even if we just suppress the virus down to reasonable levels, people are going to go out and travel more. They're going to be driving back and forth to work more. Things are basically going to get back to normal. Well, the distance between normal going in, which was almost $100 per share for Valero, and where we are now, which is under $60 per share, is somewhere between, we'll say, a 50% and 100% price gain. Now, there just aren't very many dependable stocks in this market right now that you can count on another 50 to 100% gain over the next 2 or 3 years. Okay? So this is one of the last remaining opportunities, I think, in the market. I wrote an article on Valero, I think in October, for Seeking Alpha. That was actually right down here. It was pretty close to the low, and it's up 40% since then. I didn't actually buy it down there. I think I bought it more in here, and I bought again here. So I'm up a little bit, but I'm expecting a pretty big rise. Now, the pattern that I expect to repeat. Now you can see that this has been a little bit worse for them than the 2008-2009 period, in which they only briefly had earnings go completely negative. They had a bigger dive here, but I actually expect the recovery to be quicker. So I expect this to be much steeper here than it was in 2010, 2011, and 2012, even though that was a really great rise that we saw here. I expect this recovery to be much faster. Now, I don't expect it necessarily to get to these old peaks up here, but I do expect it to get back to kind of where it was going into the recession. Now, while you'll see the earnings for refiners roughly parallel kind of oil prices, it's important to remember that these guys actually make their money on the spread between oil and refined fuel. So it has more to do with the demand for fuel than necessarily whether the oil price itself is high. So it's possible for oil prices to stay relatively not expensive, and for these guys to still make to earn money. There's a big difference between them and, say, an oil exploration company or something. So I think they're a lot safer in that way. Really, all this depends on is fuel demand returning to normal. Okay? One of the reasons I think that they're still suppressed is there's a lot of enthusiasm about electronic vehicles. And so longer term, it may be true that fuel demand will go down, but that is not going to happen in the next 2 to 3 years. We are going to have very similar demand that we had, in my opinion, in 2019 that we'll have in 22. Okay, so that's kind of my expectation here. Now, the pattern I expect to repeat, you could look at this pattern here as one, but really I'm aiming for this pattern. So buying now would be kind of like buying, let's say right here, after it starts to go up, we kind of have a little bump off the bottom. So let's say you bought here and you held for the next 5 years. Yeah, I won't even go all the way to the top. We'll just go right here. So you can earn 20% per year, 150% return I don't even know if I probably didn't even go 5 years. Let's see, 1, 2, 3, 4, 5. Yeah, that's about 5 years. A little short of 5 years. This isn't picking the bottom. This isn't picking the top. You can see the top is way up here. Okay. This really looks like just a no-brainer, very solid. You could get 20% per year for the next, for the whole next cycle until we see another economic downturn. I definitely don't think that downturn's coming in the next 2 years, and then we'll just have to see what happens after that. But I think we realistically could see another 5 years before we have a really serious recession. And that leaves a lot of upside for this stock. And then another important thing to remember is, 6.5%, if they can maintain that dividend, which a few months ago I wasn't sure. I thought they had a relatively okay chance, say like a 20% chance to not cut the dividend. Now I think that's gone up to maybe more like a 70% chance that they will keep the dividend because we have a vaccine. Okay, so the odds are very good, I think, that you can pull out probably at least a 100% gain over the next 2 to 3 years. And if it takes longer, that's okay, because these guys are paying you 6% per year. You're going to find it very difficult time to get that out of the wider market. I mean, the S&P 500 itself it's implying more like a 4% return over the very long term. So it might get more than that in the next 6 months or so. But after that, there's not going to be a whole lot of upside left. So I view this as a really, really good opportunity. As you can see, they have a good credit rating. The difference between what I would call a high quality cyclical opportunity and one like a Carnival Cruise Lines or a Boeing or maybe even some of the car manufacturers, although they're looking a little more bullish lately, is those companies have taken on a lot of debt. They've issued a lot of shares in order to basically not go bankrupt during the COVID decline. Now, Valero's been hit hard, and that's why the stock price is down. But these guys haven't taken on a lot of additional debt. They haven't issued a whole bunch of new shares. Okay, so their recovery is going to be faster. So it's that relatively speedy recovery is what I'm really, really focused on here. And then if we look back, Valero has a very long history. Okay, so this is the historical drawdowns for Valero since 1986. Okay, and we can see what I want to focus on two things here. One is how much the drawdowns are. So 65%. Actually, they might list them out here for me. Here we go. This will be easier. So we're looking at, and these are monthly. In reality, these are actually all going to be a little bit deeper than what they show here. So these are probably like 50% declines here, and these are like 65 to 80% declines here from the peak. But the important, so it's very cyclical, but that's what gives you the opportunity to buy near the bottoms. So if we look at the bottoms here, you can see them on the chart. What's important is they recover, and they recover in a very timely, relatively predictable fashion. I mean, oil in the 80s got absolutely crushed, but you can see that from 88 to 89, in 1 year, that stock price recovered. I mean, that's over 100% return in a year, basically. But the important thing is since this is a drawdown chart, whenever you see this go up to the top like this, that means that the price is fully recovered. Okay, so it's fully recovered. If we just look at the big declines, once, twice, 3 times, 4 times, 5 times, and then this is the 6th big decline that we've had. Okay, and you can see we would be buying, it's almost 50% off of its high here. So if this recovers, that's like 100% return, basically, because it'd be like buying a $100 stock at $50. Basic value investing. It took a little bit longer for that 2008 decline to recover, so it took like 1, 2, 3, 4, 5, 6, 7, 8 years, 7 years, we'll say, to recover, maybe 8 years. But it recovered from like a 75% drawdown. So over 7 years, you're getting like a 350, 400, probably close to a 400% return, honestly, if you managed to buy that at the bottom. So yeah, it took 7 years, but you quadrupled your money on the stock. Okay, so that's what I'm looking at. I'm expecting a similar type of recovery, and as long as it does that, you're going to do very well in the stock. Now, if the vaccines don't work, if COVID comes back, if something else comes along that really suppresses fuel demand, then it could be a while. Maybe they end up cutting their dividend. Maybe it takes several more years, but they're probably not ever going to go bankrupt in the next 10 years. I mean, they just have so many resources. They basically have all the resources that a company like Carnival had to raise money and stay alive. They still have all those resources available to them if something goes really bad. So you could still lose money. I mean, the stock price could still go down, but over the medium term of 3 to 5 years, I think this one is definitely a buy, and I'll be adding it to my buy stock list. Okay, so that wraps up my Valero analysis. And I just gave you the very straightforward of what I'm looking at here. With highly cyclical stocks, I like to look at the price cyclicality mostly because the earnings are very hard to predict. And I'll add this one to my buy list, and I'll also add HollyFrontier. I am long both of these for the medium term. And if you have any questions, drop them in the comments section. If you enjoyed this video, make sure to subscribe. Later.